Started now. Everyone, welcome. Good afternoon. Good morning. My name is Jalen Carter. I'm a program manager in the community wing of the Tulane Innovation Institute. We're really excited today to chat with you today about exit strategies, revealed private equity or IPO. We've got Gary Owens here. I'm going to read Gary's bio. Gary Owens serves as the CEO of Mesa Laboratories, a diversified provider of life science tools catering to the bio, pharmaceutical, and clinical genomics segments. With a profound background in strategy, sales and marketing, M&A, company integration, culture building, operations, regulatory compliance, and capital markets, Mr. Owens has successfully led businesses ranging from 40 million to 500 million in revenue. His prior experience includes roles at Danaher, where he served as a manager, integration lead, and played crucial roles in business development with Powell, Beckman Coulter DX, and Beckman Life Sciences. In the early stages of his career, Gary worked with Bain & Company, Trilogy Software, and Accenture, focusing on commercial strategy, commercial execution, and M&A programs. Gary Owens' technical expertise spans analytics for proteins, cells, genomics, as well as chemical and physical parameters in biopharmaceutical research, development, and bioprocessing, along with clinical diagnostics. His market-level understanding encompasses biotherapeutics based on proteins and emerging modalities in gene therapy, cell therapies, RNA, oligotherapies, peptides, stem cells, ADCs, and more. Gary Owens holds a BSc in Mechanical Engineering from Tulane University and his Master of Business Administration degree from Columbia Business School in 1994. Gary, thank you so much for being here today, and we're excited to hear what you have for us.
Well, thank you, Jalen, for the kind introduction, and I'll let everybody else judge where I'm an expert, but I can dabble obviously a little bit broadly, and hopefully then maybe serve as a resource for connecting you to real experts in each of those areas. So exits, right? Exits are a thing, and I think this is how everybody thinks about it, right? The exchange of money for control and ownership and direction of your business. And that is probably true in the simpler fashion, but there are lots of varieties in between full control and full exchange of liquidity for a business. As Jalen mentioned, right, my experience is primarily in what a segment called life science tools. These are all the techniques required to support, produce, and identify new molecules for therapeutics. My experience at Danaher, which is one of the largest players in life science tools, involved a heavy number of acquisitions. So I have primarily been on the acquiring end as a strategic acquirer of companies looking to exit, whether they are entrepreneur exits or not, right? And that's a slightly different flavor than private equity. But having conducted tens of billions of dollars in acquisitions, over 30 different transactions, I would say probably 20 of those or so involving entrepreneur exits. Today I live in Denver. I've lived a lot of places in between here in my time, but I am a native Louisianian. Obviously, I didn't put all this content together myself, right? So we have, in terms of my role as a public company and doing acquisitions, we have lots of relationships with investment bankers and other people. And so a lot of material you'll see today is coming from JP Morgan as the original source, or Jefferies, or some IPO statistics from the University of Florida. And what I'll do is I'll kind of give you a little bit of my interpretation of what some of these statistics mean and how I would think about them and process them if I was in your shoes. And my idea is your shoes are essentially the founder CEO of a company looking to do something different. Okay, so with that, here's kind of our outline that we'll go through today. And really, a large part of this is really the right path depends on what you're trying to accomplish. Because while we'll talk about it as if there are a couple of binary choices, even within those choices, there are lots of different flavors to accomplish different goals or to optimize slightly different trade-offs between your goals for strategic advantage, liquidity, control, and the strategic direction of the company long-term. And we'll talk about the two main flavors because those really do dominate the majority of the transactions and how those things might trade off. And I'm assuming that we're not talking about at all about what I would call early stage growth capital, which would be, I think, in the previous session where we talked about venture capital and other sources of findings to help you initiate and start a company. This is more one of the later milestones in the life cycle of a company. So your goals. Well, your goals aren't your goals, meaning there's more than you involved in any one situation. So this is obviously Google, right? And so you've got Larry and Sergey on the left. They were the founders. Well, they have their own perspective and their own degree of influence on what's going to happen. Even though Eric Schmidt in the upper right-hand corner was the CEO and the senior executive team who were charged by the shareholders with responsibility for driving that company's strategy and its approach. Naturally, down in the right-hand corner, you have John Doerr and Mike Moritz, who were the venture partners at Kleiner Perkins and Sequoia. They had a substantial financial stake in the company, and that gives them a role. And of course, I think we know that employees have become more than employees today, right? At times they can be employee activists or they have substantial stakes. But, for most founding companies, employees are the company. And therefore, you have to take their considerations into approach too. And so if you're deciding on where to go, you have a lot of people, even within your own team, to balance. And the power balance isn't equal, right? So often if you're the CEO, you've got to deal with the founders who had an original vision and very passionate about what they're trying to do. You've got to deal with the people on the bottom right-hand corner who are all about the money. And they're about their money, not your money. They're about their money and their tranche of the capital structure. And then on the left-hand side, right, these are the people that you need to keep happy. And we've seen, right, lots of activism and how disruptive employees can be, but also how important they are to the future of your company. So you've got to figure out how all those things trade off. And I'll just kind of go through and say, as you think about it, this is a chart put together by Jefferies that they would share with you and talk with you about if you were thinking about exiting. You've got some real choices to make on what your goal is. On the y-axis, right, are you trying to accomplish something strategic, right? That could be meaning the right business move for your entity is to evolve its ownership structure and how it's organized to accomplish your strategic goal. You can no longer do it entirely on your own, or potentially you're getting so complicated that you're not clean and able to focus and you need to carve off some pieces. Those are both technically exits, right? On the bottom is your focus for liquidity, which really means cash back to your shareholders. Now, oftentimes you can be going, liquidity can also be strategic, meaning you need to raise additional funds to continue your growth strategy, and you could technically be in an exit. Likewise, there are ways to structure a transaction or an exit that are more or less complex. Traditionally, you'll see on the right-hand column things like mergers or equity financing of minority stakes. Those actually have a fair bit of complication because the number of potential parties that you could be selling to or could be transacting with are relatively small and relatively well-defined. And so that can complicate things on a smooth timeline to an exit. Whereas on the left, where you have deeper pockets of capital, whether those are the public markets with thousands of potential investors in an IPO or debt and financing, those tend to be more structured transactions that are easy to do. So there are lots of different ways, depending on what your objectives are, to accomplish your end goals. So this is my interpretation of all the different trade-offs, all the different flavors that you can actually go through. And what you'll see on the left is financial characteristics, right? That generally focus on liquidity, timeline, which has its own risk factor to getting that transaction done, the risk, and then how much money you're going to get out. Those are all what I would call financial aspects of the transaction. And on the right are your strategic goals and what you're really trying to accomplish in this transaction. So you'll see on the rows, right, they range from an outright sale, where you're basically 100% selling out, and you are providing 100% liquidity, right, to all your investors, to all your employees, But what you are giving up is all the way on the right-hand side, which is strategic control of your business, right? If you have zero ownership, well, you have strategic control, right? You basically have sold your baby, and now this new person is going to be able to do with it whatever they choose. It's not to say that there are pros and cons there, and there are lots of different flavors. And the greens and the reds really kind of represent whether those are the intent of your transaction or the goal. And you'll see that there are variants, right? So, for instance, in the right-hand column on strategic and control, I've got therapeutics in there and a question mark, right? If you're a therapeutic company and you're forming a new molecule, often you have not yet invested in all the commercial resources, sales, marketing, regulatory required to get that molecule fully into the hands of patients. And so you might choose to develop it to a certain point from an engineering and from an R&D and from a regulatory standpoint without developing any of the commercial resources. And your goal then would be to sell it to somebody outright who has those resources and capabilities already, in which case then you're doing it. Then you're essentially selling. And that's some of the variants that I would say. So if you go essentially to the upper left-hand corner, right, you'll see if you're really optimizing for liquidity, and that's what that purple kind of lasso is meant to show, you're really going to follow this kind of outright sale methodology or a minority sale. And some of those are depending on, what you're trying to accomplish again. So if you're looking for liquidity, and if so, how much, and liquidity for who? Because often liquidity for your investors and liquidity for your employees are two very different things. And so, and you're going to have to figure out how you're going to balance those as you go throughout. If you go down and to the right, you probably have maybe some liquidity goals, but probably more strategic goals in mind, and that you're trying to advance the company either as a standalone entity or in combination with another company that you feel are required to hit your long-term business goals, and that this exit technically or this transaction is just a step towards your strategic goals. So you'll see things there like a merger, which is the ultimate combination, right, of strategic goals and depending on how you structure it, some degree of liquidity, but are very complicated to execute correctly. Or you'll have IPOs or alternative financing, which are typically things that are steps before an IPO that don't necessarily change the strategic direction of your company, right? But they do provide the capital required to continue to grow and liquidity to people. So those are some of the bigger kind of pockets of trade-offs, and there are lots of flavors in between there and lots of nuances for how you can accomplish those things. But we're going to focus on those two big buckets of an outright sale versus an IPO, so you can compare and contrast and just know that there's a whole grayscale of things in between there and thousands of choices that we won't be able to go through today on how to execute those most efficiently. But your choices for what the right transaction are not about you either, right? So you've got a whole group of stakeholders on your side of the equation, and an exit by definition follows a whole different group of new stakeholders that you're introducing on the opposite side of the transaction. And so you've got to figure out, how do I balance what I want to get accomplished with what my new investors on the right-hand side of the equation want to get accomplished? And one of the big dilemmas or thought processes that they're going through is a little bit on the same side. If you consider that you have three different major pockets of capital, right? In the upper left-hand corner, that person who's kind of reading a paper Wall Street Journal, well, okay, so it's an old picture. But their mentality is that they're actually going to be an owner for somewhere between 1 second and maybe 3 years maximum. So as they think about what their goals are to book and turn, right? They are essentially about, how long do I want to hold this business when I'm selling? So every second, they're deciding whether to buy or sell you. And they're doing it in a highly liquid market, but they have a very different set of objectives. Their objectives are now, right? And their objectives are, how much can I sell you for later? Private equity, which I put the yellow box around, they behave a little bit more like your late stage venture capitalist funders. Their view is that they want to hold you for about 3 years, and they're looking for a cash IRR return. 5 years are all well and nice, or long-term vision for your company and your strategy is all well and nice, only if it enables them to resell you again in 3 years for more money. They are a 3-year cash on cash return. They do not have your strategy in mind. They do not have your goals in mind unless it aligns with a 3-year cash on cash return, or IRR. On the upper right-hand corner, though, sell to a strategic, and they are what you would call a permanent home. There will be no follow-on transaction. The company won't be sold again. A permanent transaction, and I've primarily lived my life on that side. I would say a permanent transaction, we would say those relationships last longer than most marriages, and they take them accordingly. Those are permanent relationships. They're interested in the long-term strategy of your business. They're interested in building something together because they know that they're going to hold you forever. They're not as short-sighted. And so, as you go through, you have to realize that obviously to make any relationship work, those two sides need to be in balance, and your goals and their goals also need to be aligned. And I will say, I apologize, I do know a fair bit about private equity, if only because my younger brother, who wasn't smart enough to go to Tulane, he went to Emory, ended up being a private equity guy, and he's been in private equity for the last 30 years, and he kind of has his own fund up in New York. I love the guy, but he is a private equity guy. At the end of the day, though, the reality is probably if you're a smaller company, you're 12 to 15 times more likely to actually sell than you are to IPO. I know a lot of us start companies, and the IPO exit seems like a heck of a lot of fun. And it can kind of form an emotional capstone to a career. But the truth is, you're much more likely to accomplish your goals or the next evolution of your company by selling. And what these are deal counts on a year-over-year basis. And, they're min-maxes as these things kind of flow throughout the year. But reality is, the vast majority of you will end up selling your company as opposed to IPOing it or merging your company in some way, shape, or form. We'll be able to talk about the IPOs because it can be fun, but we'll focus a little bit maybe more intensely on the left-hand side, which is what does it take to really sell your company permanently. So we're going to talk about outright sale, and I'll assume it's outright sale. Minority sale is just a flavor, right, or a partial step towards an outright sale. And whether you're selling to a strategic buyer, so a permanent home, or a private equity buyer, which would be a temporary home. Okay. The reality of what's going on today, I think we've all heard, right? There were M&A booms in, 2017, 18, 19, leading up to 20 and even 21. And then as the interest rates climbed, we saw a stock market contraction, particularly for high growth companies, which are more interest rate sensitive in terms of valuation. So for those of you who are maybe not as close to your finances you were anymore, right? Interest rates lead to a discount rate. So cash flows that are a very long time away get discounted back at a higher rate. That means they're worth less. So essentially what you've seen is a contraction in the valuation of high growth companies over the course of the last few years as interest rates have gone up. That has led to a dearth of capital available for private equity and other people because they're often based off of debt-based financing, and the inability for people to come to agreement on what valuations should and could and should look like, where sellers traditionally are holding on to the strategic value of their company and looking back to 2021 and thinking that way, when the reality of the public markets today, which you always are, is kind of like a barometer for what your relative valuation is to public markets, has changed. And so you've seen M&A volumes kind of contract, and this is a quarterly view, and you're starting to see that bounce back a little bit now in 2023 and entering kind of 2024. So it's really not that bad from an M&A volume standpoint today. But it's certainly not what it was. And I think if you ever think that if your mental time frame is 2019, 2020, you're going to have a very hard time getting a transaction done in today's market. Not that those market conditions could not recur, but they're not recurring today. So what's going on in the public markets? And the reason that we talk about the public markets is because private company valuations are loosely tied to publics. Because any one investor or the other half of that teeter-totter has the options to invest in private companies, which have advantages and disadvantages, or public companies. And today, so you're always being compared to public companies. And the truth is that as public market companies' valuations have gone down, by definition, that brings down private company valuations. So what you see on the left is essentially what's going on in the stock market. And despite the stock market being close to all-time highs, you're seeing that a lot of that all-time high is actually concentrated in 7 stocks, right? Those are the Magnificent Seven who are exposed to artificial intelligence or electrification are really the primary drivers, right? So NVIDIA, Alphabet, Microsoft, all those people, Meta, are big AI companies, right? Tesla is probably the one outlier there that actually isn't. Tesla and I guess Apple are the ones that aren't actually being a lot driven by this AI phenomenon today. So that's what you see in the kind of the S&P 500, right? You're saying, hey, look, on the left-hand side, the darker columns, those are current valuations. They look really nice versus our long-term average. But the truth is in that orange column, once you strip out the impact of those 7 stocks, you're back to the S&P 500 is equally weighted. And then what you see is you go to smaller companies on the right, the S&P 600 versus the S&P 500. That's a reflection that the smaller end of the spool or smaller stocks are trading at a meaningful discount to larger stocks. So you can't just look at the S&P 500 average, which is dominated by a small sample of companies that are very large at the top end of the S&P 500 to know what's going on, assuming that I'm not talking to anybody who owns the current version of Microsoft, Google, or Amazon on this call. So you got to know that your end of the pool, right, today is trading at a relatively meaningful discount, that 13.8x or lower, relative to a traditional level of 16.5. So for a long time, smaller stocks were actually trading at a premium to larger stocks because of their opportunity for growth, outstanding growth relative to larger stocks, just because you're smaller. By definition, your sample size enables you to have the potential for outsized growth. But today, unfortunately, those stocks are trading at a meaningful discount. And I don't mean to say that's bad because that's the end of the pool that I swim in, and it's not been the most fun for the last couple of years. But it will turn again. So you kind of have to be a little bit realistic about what's going on in the stock market today. M&A volume, right? M&A volume, and you'll see up top on the years, right? You see a long-term trend towards higher level M&A volumes. And between the orange and the blue line, what you're seeing are that balance between strategic investors and financial sponsors, or think of those as private equity primarily, right? So you're seeing for long-term increasing overall volumes. You're seeing an increasing share of transactions being conducted by private equity. And then what you see is after 2011, right at the beginning of 2022, when interest rates started to spike, debt markets got gummed up, you're seeing that those volumes are trailing off. Those volumes at close to $2 billion a year worth of transactions in North America, that's only bad in relation to what happened in the back half of the 2010s or 2015s, right? So that 1.9, 1.8 billion the last couple of years, everyone's talking about an M&A volume crash. But the truth is that crash is only relevant when you compare it to some recent years, which were relative boom years. So there's still a relatively healthy M&A market available for you. And down on the bottom, you're seeing essentially the same chart with a monthly characteristic for what's gone on recently. And so you're starting to see those M&A volumes picking up. So I think you can expect that if you're looking to do things, that the M&A volume, M&A will become more favorable in the near term, and we'll start to see more transactions happen. And of course, this is what the bankers would say. I will say I'm a strategic guy, not a banker. The bankers will say a lot of things. They will say forever that M&A volumes are on their transaction up, and forever that IPOs are greater. So you got to kind of take what they're they're saying with a little bit of a discount rate. And I get back to the facts. So, two different versions are minority sale or majority stake, right? Minority sale, you're selling a big chunk to one shareholder of interest or maybe a couple. And that usually has some combination of liquidating part of your business, still maintaining a certain amount of strategic integrity or strategic continuity for your team. But they can be a little bit harder to transact, right? Because nobody wants to necessarily own 20 or 30% of your company without a certain degree of control, right? It's too much of a bet for them not to have control. It's too illiquid for them not to have control. So you're always going to be fighting that. But obviously, a majority stake, which means that you're giving up, very clearly giving up control. You might be giving up the entirety of the share capital. You might end up with a residual stub. You're basically establishing an entirely new strategy and slate structure, and it feels a little bit different to you on one end. Either of those two can be the right goal for you, depending on how much liquidity you're looking for and how much control or strategic direction you're looking to give up. The process. This is what the bankers would tell you. The bankers would tell you that selling your company is a 6 to 9 month process once you get started. What they don't tell you is that getting started or getting prepared to sell your company, that probably adds another 6 to 12 plus months, right? So really about the time that you are decided and you're ready to sell your company, you should have already been preparing for a year to be in a good place to make that decision, to make a transaction happen quickly. Also know that 6 to 9 months, you're not going to sell your company overnight and get cash. You're also not going to actually understand fully what the market is by the time you're ready to sell. So in some cases, if it takes you 24 months to sell from all in, from the time you say, I need to get prepared to sell, well, market conditions can be very different by that time, and you may choose that the market conditions are no longer favorable to sell. So you got to be convinced yourself you're going to spend a fair amount of time well in advance deciding that you're ready to sell your company, and you're going to have some risk. And so you may decide to pull that, or you may decide to try to accelerate it. That's important because I think of this as this will take 75% of your time. Once you're in this transaction, that 6 to 9 months, you will not be running your company. You will be running a sales process, and you will be hoping that your company is running itself to a certain extent in between here and there. You're going to be spending what I call 75% of 150% of your time driving this business. It will be more than a full-time job. You will not see your family. You will not see your friends. You will not do a lot of things. You will be super and hyper intense to get this all done. So it is a really big decision, and you need to be well prepared for it. Likewise, you will no longer, when you're running your team, you feel like you have insight into everything that's going on in the company. This part of the process, you will no longer have great insight into it. There will be a lot of people going into this. You're going to feel like you're going into surgery, and they're putting you through anesthesia, and there are 15 doctors standing around your table, swirling around, putting probes into you, putting tubes into you, giving you drugs and drips. These are going to be investment banks who are going to help to coordinate a lot of this. They're going to help the tactics and strategy, the selling. They're going to find the buyers. They're going to position you. They're going to help you with the marketing documents. Tax firms and consultants. These are people who are going to prepare your company to be inspected from the outside in so that you can withstand all the due diligence and other things. They're going to provide updates on the quality of earnings. You're going to have audited financials and all these other characteristics that are required that maybe you didn't as a private company. There'll be law firms running up bills left and right. There'll be data room providers. There'll be all kinds of things going on that will take place. If you are, let's say that you're selling your company and maybe it's worth $200 million, you can figure out that $200 million, it's probably going to cost you $4 to $5 million in fee to the investment bank and another $3 or $4 million worth of fees to tax firms, consultants, legal, virtual data room, and everything else to actually get that transaction accomplished. That said, running through an investment bank by definition, right, their whole job is to essentially develop a compelling tension and trade-off to maximize your valuation. But it is a big deal. This is the most likely path for you to exit ultimately, and it is a major commitment. We'll talk about the other alternative, which is an IPO, which really means you're selling a portion of your company into the public markets of Wall Street. So what's going on in today's IPO activity? What you'll see on the top is kind of the activity levels. And what you saw in 2021 in the upper table, upper left-hand corner, right? People raised around $300 billion doing IPOs in 2021. They had to disconnect the chart because it was so far off the chart, right, that the chart wouldn't have made sense anymore on the y-axis to compress it down. And what you've seen now since then is essentially a severe contraction in the IPO markets. Why is that true? Again, it gets back to interest rates, and the value of high growth companies in the public markets today have crashed as interest rates have shot up, because they always have alternatives for what to do with their money. You're starting to see some of those things trickle along, but the IPO markets are still, to a large extent, I don't want to say dead. I would say in hospice maybe, or kind of having their own near-death experience. And what you see on the upper right-hand corner are the kinds of companies that are acceptable to go public today. The upper right-hand corner, real estate, financials, consumers. Those probably, I'm going to be nice and say, those probably aren't the most relevant for us. Those tend not to be entrepreneur-owned companies. Real estate, these are probably typically real estate investment trust or other groups that are splitting up. And so, half of it gets spun out of a bigger company, or bigger company splits in two, and they go off and form a real estate company. Financial companies obviously are a lot of money. Consumer companies are a lot the same way. You'll see, I guess, what was it? J&J's consumer arm got spun out separately from Johnson & Johnson. Those are the things that are in those statistics on the right. The primary group of what I would call founder-led or started or venture capital-backed companies are going to be in technology and healthcare sectors. That will be 95% of what I would call venture-backed companies going through the IPO route will be in the technology or healthcare sector. Today, right, IPO market's dead, and this is what JP Morgan says is kind of predicting what's going to happen with the IPO markets over the next couple of years, right? It's going to have to reestablish itself with some big, highly profitable companies, right? ARM, $50 billion valuation, Instacart, Kenvue and Klaviyo, I believe, are both spinouts of different companies as they seek to delever. And then they're seeing that at some point in late 24, 25, we'll see a return to IPO markets. I'll just say again, JP Morgan, like all the bankers, are paid to be optimists. They only make money on optimism, and so they are, by definition, go on the potential of going IPO. I think more realistically, with interest rates staying higher for longer, you're probably looking at 2 to 3 years before we return to quote unquote normalized IPO markets. The truth is, did I miss one? I did. I skipped one. Sorry, I pulled one out. The truth is, it is not an IPO golden market, right? I apologize for not having a slide in there. I'll put it in the slide deck that we have later. The IPO golden market ended in like the 1990s. You had about versus 2018-19 when we saw those high proceeds. I'm sorry, here it's say 2021. That number looks great compared to 2022, 23, and 24. If you go back into the 90s, though, those numbers were like 8 or 10x higher. That was the golden age of IPOs, were like the 80s and 90s. But since then, with Sarbanes-Oxley regulations, with a dearth of active investors as everything has gone to index investing and other things, with the overhead required by the PCAOB, which is a public company accounting board and oversight board, D&O insurance, legal lawsuits for everything that you do as a public company. It's really driven down the number of companies that can go IPO and essentially raise the overhead of being public to the point where it's not the most attractive exits for a lot of people. So if you ever decide to go IPO and you think that the selling process of your company being maybe 18 months or so in duration is long, the IPO is longer. So preparing your company to be ready for an IPO involves a whole lot of steps, right? The preparation piece. And a lot of this has to do with the constrictions of being a public company and all the requirements, right? For financial reporting, for controls, for governance and oversight that are unusual for a private company. But there's also the investors, on the other hand, are by definition trading in and out of your stock all the time. And what they don't fully understand is the difference between strategic outcomes and financial outcomes. You trade off of financial metrics. You do not trade so much off of strategic metrics. And so if you're in a state where your financials are volatile because you're trying to do things strategically that are important, even if your strategy is very consistent, you're making progress, but your financials are volatile, they don't understand it. They don't like it. They throw up on it, and it leads to lots of noise and consternation amongst your people. So that's why you have such this long process for preparing to go public, right? 12 to 24 months. The execution could take 9 months. Once you're public, if you do not hit your goals for the first 4 quarters, you will be slaughtered. By slaughtered, I mean they will take your public company stock that maybe went public. Let's say it's $50 a share. They will drive you down to $5 a share because you're not predictable. So now all those employees that you thought were getting liquidity exits at $50 a share, well, they're really getting $5 a share, and they're more mad now than they ever were before. So really the only time to go IPO is when you're prepared and have a certain scale, you're very predictable, and your predictability needs to last 2 years, right? And I know that's a pretty hard thing to do for a smaller company, but if you're kind of in the software world, that kind of consistent predictability for a couple of years on the financial basis is important. And if you're in the therapeutic world, which is the predominant characteristic within the healthcare, your strategic progress in terms of getting that molecule to market needs to be on point for a couple of years. So there's a very high bar today to going IPO. Okay, I did have it. Okay, so this is the number of IPOs over time. And I'll go back to that 1990s. If you went back to the 80s, the numbers were a little bit higher. Those numbers are all really a lot higher. That was the golden age of IPOs. That little spike you see on the right-hand side in 2021, that's what we term the golden age of IPOs today. It's nothing like what it was. You'll also see that there are 3 different lines there. Those represent TMT, so technology, media, telecommunications. Think of that as the tech ones from earlier. Life sciences, and that's a subsection of healthcare, or that's maybe the broader healthcare, but that's really, we'll talk about that in a second, life sciences, and then everything else, right? And so that really tells you today, 2/3 of IPOs are either technology driven, life sciences driven, and then 1/3 are other, but that 1/3 other is really spin off from big companies or real estates or really big things. And if you're one of those companies, then you probably have a fleet of advisors already because you're a big company and not benefiting from my conversation. So we're going to focus on those 2 other people, the tech companies and the life science companies. There's a whole bunch of background. I won't go into it, but there's a tremendous amount of background that goes into being prepared for IPO. It is a heavy lift. A lot of it is actually good for you as a company, so it's not a complete cost, but can be a heavy lift. Pros and cons, I won't go through this either, right? But you can kind of read it off, or if we're posting this, then great. It does provide a path to liquidity. I think some of the good things are it can help your business strategically, and that you're more prominent and you become more well-known. It's easier for customers who are vetting you as a supplier to understand that you're a public company, and therefore they believe in your resilience and they're willing to invest. It's good for attracting talent. People kind of like it. It feels better to work for a public company because they know that you're going to be around. And on the right-hand side, there's lots of constrictions or constraints that go with being public as well that are new versus what you might have enjoyed as a private company. Okay, if you're a tech company, IPO, the world has changed in the last few years. So what you're seeing is essentially the current year revenue, the forward growth rate, and the forward profit and the profitability rate of your company. And you can see that up until 2022, right, you could be a quote unquote relatively small company. You could be maybe a couple $100 million in revenue as a technology company and still go public on a viable basis. You still had to have exceedingly high growth rates, kind of growth rates in the 20% range. And you didn't necessarily have to be profitable. If you're a tech company, I think you probably all would have heard of the rule of 40, right? That says you add your forward revenue growth rate and your profit margin rate together, and you want that number to be 40 for a SaaS company. That used to be like an aspiration. And the truth is that for an IPO, that's become more of a rule lately, right? So you can't just be completely focused on growth at the expense of profits. You have to be able to do both as a tech company today to go public. That rule has changed. And, if you're 3 to 4 years out, that rule may change again, right? Back to being what it looked like in 18, 19, 20. But I do think now you're seeing that to exit via IPO, you have to have a much better balance between profits and growth. You can't just be a one-trick pony, all growth, no profits. And certainly you can't be a company that is all profits, no growth, because then you're going to be stuck permanently in that lower size category and trade at a meaningful discount to what you think you should, because the bigger companies are going to trade for a premium. And that's likely to continue. So the rules changed a little bit. And this kind of represents essentially JP Morgan's view on what's the value of growth relative to profitability, right? So you need to know if you're going to monetize things, what is that trade-off? Should I be trying to overdrive the business for growth? What's my right balance between profitability? How much should I be forward investing in next year's growth today? And that's changed. That's essentially that dark blue line. So there was a period, right, in 2021, 22, where it was growth at all costs. And it didn't really necessarily matter. We were cost unconscious in terms of investing for forward growth. And that has probably now today returned maybe a little bit below the average, but now you're seeing that there's a much heavier balance between essentially what amounts to the trade-off between cash flow and growth. So that says, 1% of growth is worth today 1.9% of free cash flow, where before it was worth 10 times that amount, right? And so you're seeing today, you're forced strategically to make the right balance between profit growth and top line growth. And today that's swung backwards a little bit more towards being at least on a path or clarity to profitability. For healthcare IPOs, what you're seeing are the SIC code categories of those companies that went IPO in 2018. So it's just a snapshot. But the reality is essentially what amounts to life sciences or therapeutics, new molecules, new drugs, think of that, is the predominant group that's going to go IPO. It's very hard if you're a med device company, lab services like a genomic testing lab to go IPO today. Those have been kind of burned down. And I would think if you looked at the med device companies, those are typically going to be very large companies that are spin outs and other things. So the predominant group is going to be therapeutic companies. And on the right, you'll see how much progress people are expecting you to make in terms of getting your therapeutic to market before you can go IPO. IPO is still a very viable path for therapeutic companies today. By definition, you'll see new drug application, right? That means that your drug is starting to go on market. All the other ones are in various phases of clinical trials. If you are a one therapeutic company, which a lot of these are, or even multi-therapeutics, the truth is you have zero revenue, right, through here. So you can actually go public with zero revenue in the healthcare space if you're a therapeutic company, if you're making scientific and clinical advances enough that give people a path to a runway. So your structure for how you think about the trade-off between selling your company, IPOing your company, all vary very strongly based off if you're in one of these two classes of different groups. Running a software company looks very little like running and the trade-offs that you would face as a therapeutic company. A therapeutic company, you could be 6, 7, 8 years ahead of even releasing your product into market. And so therefore you think of a healthcare IPO as almost like a late stage venture capital. The reason that it's like late stage venture capital is because you're still building a business strategically. Your financials don't look necessarily great, but your growth promise is fantastic. But the truth is, if you're a healthcare IPO, venture capital doesn't have enough money to support your clinical trials, right? You could be spending tens or hundreds of millions of dollars to get through these clinical trials. And there's a pocket of pool in the IPO market that can support that. So it is a very viable path for a company. Obviously, the burden on going public is a lot less. Why? Well, what are your audited financial statements when you have no revenue? It's pretty straightforward, right? It's essentially cost accounting. Your registration and your focus on strategically is very clear. I'm making this one molecule, a couple of molecules. We're going to solve Parkinson's. Parkinson's is a disease. All your data is known. So it could be a lot easier technically to go IPO a little bit earlier in your life cycle if you're a healthcare company, and less burdensome and less costly. I'll just say the less costly really means it's still going to cost you $3 to $4 million just for transaction fees during the IPO, and maybe $4 or $5 million worth of preparation to go IPO in terms of building the infrastructure required. But that looks a lot less than it would if you were what I would call a bigger company with revenues and lots of employees and other things. You could be a relatively focused company in the therapeutic space and conduct an IPO. If you're not quite ready for an IPO, meaning you need more capital than you can easily access, and or you want major public investors to put a stamp of approval on your business, you can go to alternative capital sources. So the equivalent of this is saying essentially, I'm going to go to Fidelity. I'm going to do a late stage venture capital round. Only instead of going to a venture capital company, I'm going to sell it to a public investor. T. Rowe Price, Fidelity, Wellington, all these people who have big pockets who invest in IPOs. There, I'm going to give them essentially a pre-IPO round, only they're essentially going to validate it. So when I do IPO a couple years later, I already have a pre-established book of high-quality investors in my stock, and that makes it more favorable. So that's a nuance that's happened today that really helps to validate companies. Whether you're a healthcare company or a technology company, you could still kind of go this route as an interim step before IPO. As usual, it takes a lot of effort. Really, I kind of highlighted that future exit. These are people who are in it for a couple of years, knowing that you're going to IPO. So you kind of need to have a little bit of your direction already set, right? If they're not a venture capital who says, we're going to sell this company later or something else. They really want you to IPO, and they're essentially getting an early look at an IPO. That's why that's a little bit different. There are lots of different pockets that you can go to, and investment bankers can help you through this. But there's lots of different pockets, and the fact that it's private is what makes these transactions more complicated and really only an interim step. So, my summary, know your goals. IPOs are rare. They sound attractive. They sound like a lot of fun. You should dream your dream, but you really need to do the right thing for the company. An exit is not an end. An exit is just the next stage and evolution of your company. Whether you're there or not to see that stage, it's not an end. You need to maintain a bias for growth, but you have to be more balanced today in terms of your balance between profits. Success in any exit depends on preparation and predictability. People buy predictability. If you are unpredictable, they have to put a discount rate that you're not going to enjoy on the value of your company. So be predictable and be well prepared. And your sell side advisors, people are going to help you through this process. They do this all the time, right? They do this. I work with the head of healthcare at Jefferies and JP Morgan. Those guys are doing this 10, 15 times a year. You're doing this once in a lifetime. So you're really going to need to count on them and help to drive it forward. So with that, that's really all I had, and I hope I didn't run over too far. But
No. We're still well within our time for today. Gary, thank you so much. I would like to open the floor. If anyone has any questions, you're more than welcome to blurt them out or put them in the chat before we fully wrap up our webinar today.
Gary, that was a great webinar. It just hit the right tone. So it was like really educational for people who kind of had no idea, but it was also deep enough for people who were well versed in the matter. And it actually, I don't know if you saw in the chat, but it inspired a request for a deeper dive on the M&A prep process. So we're going to think through sort of how we tackle that and the correct audience. So thank you so much.
Sure. Not a problem. If there's, if people have immediate questions before that happens, I'd be happy to work with them or put them in place with, different sell side advisors who are experts in that field.
Yeah, great. Okay. So, I just want to echo everything Sharon said. Gary, thank you so much. Some of my nuggets, I always like to take away from these. Stakeholders have different agendas. Make sure you understand that. Liquidity and in general, everything you're doing must be balanced was another nugget I had. Predictability is vital if you're going to go IPO, was another thing that I picked up from this. And all that really valuable information about the history of IPO, the history of a lot of these structures, I really appreciate it. So Gary, if you wouldn't mind going to that very last slide for me. Thank you everybody so much for joining us again for one of our webinars. This is, Sharon, please correct me if I'm wrong here. This is our final webinar before we go on a summer hiatus. We're really excited to jump back into this starting next fall. We're going to have a really cool slate for you. And if you're in New Orleans, please join us at Startup NOLA Ecosystem Happy Hour at the Broadside, New Orleans. This is from 5 to 7 p.m. There will be free food, free drinks, there will be music, and it will be a great opportunity to connect with other founders and funders and incubators in our New Orleans startup ecosystem. So once again, Jalen Carter, favorite picture myself, saying peace out to everybody that joined us. Gary, thank you again.